Good morning everybody and welcome to our third webinar for 2017. Now in this webinar we're looking at the new AASB 9, specifically focusing on the recognition and measurement requirements. Just a reminder before we start that this presentation is for training purposes only and it's not accounting advice. And if you need accounting advice, we'll have to specifically look at your facts and circumstances. So the outline of this session, in the new AASB 9, there are, I would say, three main areas impacted. The one is recognition and measurement requirements. The other one is impairment of financial assets, and the third one, hedging. And you'll see we've therefore scheduled 3 different webinars in 2017 addressing those different aspects. Today we're focusing on the first part, and that is the recognition and measurement requirements, and a big part of that are the new categories of financial assets. So the outline for the session, I've got 6 sections. Number 1 is the background. Number 2, the new categories of financial assets. Number 3, the recognition and measurement of financial assets and how that have changed. Number 4, we look at the categories of financial liabilities, and I'll tell you now it hasn't changed from the current AASB 139. We'll then look at the recognition and measurement of financial liabilities where there's a small change around own credit risk, and we end up with a few key messages on the new AASB 9. So today we're focusing on only one aspect of the new AASB 9. So why now? As you know, we've got the triple threat accounting standards, the new AASB 15, 9 and 16, and the new AASB 15 and 9 are effective for years beginning on or after 1 January 2018. Which means if you've got a 30 June year end, 30 June 2019. If you look at my timeline at the bottom of that slide, if you apply the new AASB 15 and 9 for 30 June 2019 year, you have to apply these standards retrospectively. Therefore, your comparative year will be 30 June 2018. The start of your comparative year is 1 July 2017. Today is the 15th of March, so we're talking another 3.5 months before the start of the comparative year. So it's close by. We have to start to think about it, do an analysis on how it will impact us, get ready, gather the correct information. So a bit of an introduction. So why do we have a new AASB 9? It all started in the global financial crisis. So if we look at the current categories of AASB 139, currently AASB 139 have 4 categories of financial assets. There's fair value through profit and loss. We've got loans and receivables, so our trade receivables, trade debtors, loan receivables. We've got held to maturity. And we've got available for sale financial assets. And currently that available for sale financial assets is like the bucket. If a financial asset doesn't fit into fair value through profit or loss, or doesn't fit into loans and receivables, or doesn't fit into held to maturity, it ends up in available for sale. Now, available for sale is a problematic name because if we've got financial assets that are held for trading, they actually fall into the fair value through profit and loss category. So the name available for sale is a problem. It could lead to a bit of confusion. So please note, if we've got a financial asset that's held for trading, so investment in shares held for trading, derivatives, it's fair value through profit and loss and not available for sale. So yes, the name of that category is a problem. The other problem with that available for sale category would be impairment requirements, especially if you've got investment in shares or equity items that are within that available for sale category. Now, to illustrate that, I thought I'll do a small example. So let's say on the 1st of January, we've got Entity K acquires 100 shares in Company A for $100. So that's on the beginning of year of 2018. On 31 December year 18, the fair value of those shares in Company A is only $60. And let's assume that these shares are impaired in terms of the current AASB 139. Then on the 31st of December, the fair value of those shares increased to 110, so the market has recovered during 2019. And on the 3rd of January 2020, Company A sells the shares, Entity K sells the shares in Company A for $110. So the question is, what are the required journal entries in the records of Entity K if the investment in the shares of Company A are accounted for as an available for sale financial asset in terms of AASB 139? Now, in order for it to be available for sale, it cannot be held for trading, so there has to be some kind of longer term perspective around it. So what would those journals be? So first of all, on the 1st of January, when Entity K acquired the shares, they would say debit an asset $100, credit cash $100. Then at the end of 2018, the fair value is only $60. So they would say we have to credit the asset with $40 and debit profit and loss $40. So we have to say that we have to credit that asset, so the asset has to go down to a fair value of $40 with debit profit and loss $40. I do apologize, my numbers here are the wrong way around, but the descriptions there, credit and debit, are correct. Then on the 31st of December, the fair value of the shares now go up to 110. Now this is the issue. We're going to debit the asset with 50 because our asset always have to be at fair value of 110. And we will credit revaluation reserve, and the revaluation reserve that we credit is with 50. Now a lot of people didn't like that, because they said, look at the previous slide, you've said debit profit or loss, impairment loss, with the bad news, with the reduction in fair value, because it's impaired. However, the next year, when the shares recover, you do not credit profit and loss, you credit revaluation reserve with other comprehensive income. So what happened to available for sale financial assets that were equity items is the bad news always ended up in profit and loss, and the good news ended up in OCI, which is a problem. And then, let's say on the 3rd of January, we sell the shares, we would say debit cash 110, credit the asset 110, and then also we'll move from revaluation reserve to profit and loss the $50. Remember, as soon as we've sold the asset, we do not want a revaluation reserve. Therefore, we would clear that revaluation reserve to profit and loss. Again, I do apologize. The credit asset, debit asset there is correct, but somehow I've mucked it up on that side. All right, so that's the problem that we currently have with available for sale financial assets. Now, going forward, when we look at the categories of financial assets, the new categories of financial assets in AASB 9 are fairly different. So on the one hand side, we've got amortized cost. Then we've got fair value through profit and loss, which is similar to what we currently have. Then we have two new categories. We've got fair value through OCI, and that is fair value through OCI, which are equity instruments. And if it's fair value through OCI, which is an equity instrument, no recycling would be allowed. So what I mean by that is when you sell these equity instruments and you have a revaluation reserve and you don't like to have a revaluation reserve after you've sold the underlying shares, you cannot say debit revaluation reserve, credit profit and loss. The only thing you can do is debit revaluation reserve and credit retained earnings directly in the statement of changes in equity. And then the fourth instrument is fair value through OCI for debt instruments, and for debt instruments, recycling would be allowed. So we've got 4 different categories of financial assets. So currently we have 4, going forward we have 4, but it's different categories. And you can see we no longer have available for sale financial assets because the number created some issues and impairment created some issues. All right. So how do we know if we've got a financial asset, what category that financial asset would fall into? So I use 3 different decision trees to determine which category. So remember, we've got 4 categories of financial assets, but to determine which one, I use 3 different decision trees. And the decision tree I use depends on whether I've got a derivative financial asset, whether I've got an equity instrument financial asset, or whether I've got a debt instrument financial asset. So that's your first decision. Determine whether it's a derivative, an equity instrument, or a debt instrument. And then use the appropriate decision tree. So if we use the first decision tree for derivatives. And now the new AASB 9 says your first test or your first consideration is the contractual cash flow characteristic test, or a different name, same test, different name, the SPPI test, which is solely for the purposes of principal and interest test. And you do that at an instrument level. Now, the interesting thing with a derivative will always fail that test, and therefore all derivatives will always be accounted for at fair value through profit and loss. And you will remember that in the current AASB 139, derivatives will be at fair value through profit and loss. So this is not a change at all, but important to note. If we go on to the next decision tree, now this decision tree is for equity instruments. With other words, we're talking about investments in shares. So if you've got investment in shares, again, your first question is the contractual cash flows characteristics test, or the SPPI test, solely purposes of principal and interest test, and you do this test at an instrument level. Now, an equity instrument similar to a derivative will always fail that test, because if you invest in shares, it's not only to get the principal amount back or to get interest back. If there's a change in the fair value, that's why you're doing it. You want to get that change in the fair value. So you fail that, and therefore your next question is, are these equity instruments, are these investments in shares held for trading? And if you say yes, held for trading, you've got no choice. They have to be accounted for at fair value through profit and loss. Now again, that is the same as we currently have in AASB 139. That's not a change. However, if you've got an equity instrument that's not held for trading, the new AASB 9 gives you an option. It's an irrevocable option to elect fair value through other comprehensive income. Now, if you say, yes, I want to make that irrevocable election at an instrument level, and you can do it, you can make a different election for different instruments. So you could have some investment in shares at fair value through other comprehensive income. You could have other investment in shares at fair value through profit and loss. So you can have a mixed bag. It's at an instrument level. So if you say, yes, I want it at fair value through other comprehensive income, then there can never be any recycling. It means that all changes in fair value will be in the reserve. All changes in fair value will be in other comprehensive income. Even when you sell these shares, that profit on sale will be in retained earnings. It will not. It will be in other comprehensive income. So that's really important. So if you've got investments in shares, equity instruments, your 2 options are fair value through profit and loss, if it's held for trading, or if that's what you want to do, or if it's not held for trading but you want to make this irrevocable election, you could have it at fair value through other comprehensive income. And that's different. And this is trying to address the current problem we have with available for sale financial assets, specifically equity instruments. Then if we look at debt instruments, and this includes hybrid contracts, your first test is, do we have this trade receivable as an example, or this loan receivable? Is the whole purpose to collect contractual cash flows, or solely for the purposes of principal and interest? It's the same test, different names. We do it at an interest level, instrument level. If you fail that test, you go to fair value through profit and loss immediately. If you pass that test and say, listen, all I'm interested in is principal and interest, that's it. If you pass that test, you've got another hurdle to jump, and it's the business model test. And this test we do at an aggregate level, not at an instrument level. Now, if you look at the business model test, your business model could either be hold to collect contractual cash flows, or your business model could be, yes, I'm holding to collect contractual cash flows, but I could also be selling the financial assets. So there might be a bit of a mixed business model. Now, for both of them, you can always elect to do fair value through profit and loss. That's always available. But if you don't make that election, if you've got hold to collect contractual cash flows, then you can use amortized cost. Or if it's a business model to collect contractual cash flows and potentially sell financial assets if the opportunity arises at a good price, you could get to fair value through other comprehensive income. But in this instance, for debt instruments, recycling would be allowed, which means once you sell this instrument, the profit on sale and whatever you've had in other comprehensive income could be recycled through profit and loss. And this is different to what we've got for fair value through other comprehensive income of equity instruments. So I will spend a little bit of time talking about these hurdles, the SPPI test. I will talk about the different business models, but what I've tried to do here is just show you the three different decision trees, how they work to determine which of the four categories of financial assets do you have. So this is just an introduction. So let's talk a little bit about the contractual cash flow characteristics test, or the SPPI test. So if we've got an instrument and the term of the instrument is to only provide for cash flows that are solely principal and interest, then we would say we pass this test. So the principal amount would be the fair value at initial recognition, and interest would be the time value of money and also credit risk. So they do say, listen, the most significant components would be included in interest would be for time value of money and credit risk, but there could also be other components in there. But the main things would be time value of money and credit risk. If we look at a little bit of an example on the SPPI test, let's say entity A lends developer C $500 million for 5 years at an interest rate of 5% per annum. And developer C will use the funds to buy a piece of land and construct apartments for sale. Entity A will be entitled to an additional 10% of the final net profits of that project. So remember, entity A have this loan receivable from developer C. They will get the 500 million back. They'll get interest on the 500 million back, and they'll also get 10% of the final net profits. The question is, does this loan receivable in the records of entity A meet the SPPI cash flows test, or the contractual cash flow characteristics test? That's the question. What do you think? I'll give you a moment to ponder. So is this only for principal and interest, or is there something else in there for entity A? So if we go back to that one, I think everybody is happy that it's not just the principal of 500 million. there's also the interest of 5%, there's also the 10% of the net profits. Therefore, in that situation, we would argue it does not meet the SPPI cash flow test, number one. So that's an example to illustrate that. So if we move on to the business model test, remember, if you want to get to amortized cost, you want to say, I've passed the SPPI test and I've got hold to collect contractual cash flows. Also remember, if you want to get to fair value through OCI for debt instruments, you want to pass the SPPI test, and you want to say that your business model is to collect contractual cash flows and potentially to sell the financial asset. So the two business models available is hold to collect contractual cash flows, or a bit of a combination, hold to collect contractual cash flows and selling of the financial asset. So if we look at hold to collect contractual cash flows, the purpose here is to collect contractual cash flows. You need not hold it until maturity. You would remember currently under AASB 139, that held to maturity category had very strict rules on when could it fit into held to maturity, and if it was held to maturity, it could get to amortized cost. Now this new business model test and the hold to collect contractual flows test is not as strict as the old held to maturity test. Why? Because you could have some infrequent sales. For example, you're selling it close to maturity, or maybe you are realizing it because you've got a liquidity crisis. So your intention was to hold it right till the end, but now you've got this liquidity crisis. Yes, then you can realize it and it wouldn't impact your business model test. There could be changes due to changes in tax laws. There could be internal restructuring or a business combination. So although you had an initial intention and your business model is generally to hold to collect contractual cash flows, it could change in certain situations and you won't be penalized for it. So that's a bit of a relief. If you look at the other business model or the other alternative available, this is where, yes, I'm waiting for contractual cash flows to get principal and interest, but if an opportunity arises, I could sell it. So it's a bit of both. In this category, there could be greater frequency and volume of sales than your hold to collect business model. And usually here, your intention is actually to sell this before the investment matures. So you're interested in principal and interest, you've passed that test. However, your business model is not necessarily just to wait right till the end. If prices use favorably, you could potentially sell it. So in this situation, it could be you've got investments in government bonds where the investment period is shorter than maturity, or you've got investments in corporate bonds where the investment period could be shorter than maturity. So in this situation, I just want to move this a little bit, the business model would typically not be expected to apply to intercompany loans or trade receivables. So if you've got intercompany loans, trade receivables, you cannot say it's a little bit of both and you intend to sell it. Usually it's then just hold to collect. So this is just, again, it's an option. It's a new category which gives you an option, and it's not as strict as held to maturity. So if I give you an example, let's say entity A sells goods and offers customers a 30-day payment terms. So customers have 30 days to pay after delivery. And entity A collects the contractual amount of the trade receivables and has no intention of selling the receivables. What would your business model be here? So let's assume that we've passed the SPPI test, but what is our business model here, do you think? We've got trade receivables, we're going to wait right till the end. So held to maturity, the business model would be, to wait right till the end, and we will get to contractual cash flows. Another alternative, if we look at scenario 2, let's say entity C anticipates capital expenditure in a few years, and let's say entity C invests its excess cash in short and long-term financial assets so that it can fund the expenditure when the need arises. So we have a little bit of a dual purpose here. So it is a little bit of hold to collect, but also when we need the money, we might sell them, and we know that's our business model, and we know that up front. So many of the financial assets have contractual lives that exceed the entity's anticipated investment period, and it will hold financial assets to collect the contractual cash flows, and when an opportunity arises, would sell the financial assets to reinvest in financial assets with a higher return. So we're not locked into hold to collect as a business model. Here we look at opportunities, we might need the money earlier, also even opportunity arises. So what is the business model? It's a bit of a combination, and therefore we get to fair value through OCI in this scenario. So I just want to recap. We've got 4 categories of financial assets in terms of AASB 9. It's different to the current categories in AASB 139, and in order to assess which category you fall in, there's a 2-step approach. Your first step is it a derivative, an equity instrument, or a debt instrument? And then you have to use the appropriate decision tree. So for a derivative, fair value through profit and loss. An equity instrument, it could either be fair value through profit and loss, or it could be fair value through OCI. And if it's a debt instrument, again, you've got 3 potential options. You can see fair value through profit and loss is always an option that's available. For a debt instrument, if you jump 2 hurdles, and if your business model is the hold to collect contractual cash flows, and you don't want to have your debt instrument as fair value through profit and loss, you could get to amortized cost. Also, if you want to get to fair value through OCI, where you can recycle when you sell the instrument, you have to argue that your business model is a little bit of a combination of contractual cash flow and selling of the financial asset. So before we go on to recognition and measurement of financial assets, I thought I'll ask you a question. So if I look at my poll questions, I thought, let's ask, do you currently classify some of your investment in shares as available for sale? So I've said that's a problem category under the current standard. It would be really interesting to see whether any of you currently have that. Please vote, or please give me an indication. Available for sale, really problematic. If you're in that category, you know, the new AASB 9 would be quite helpful, especially around potential impairment issues. I'll give you another few minutes. I think around 50% of the attendees have already voted, which is amazing. A few are saying not sure. So available for sale, that bucket category, how many of you currently have your investment in shares in that category? All right, I think that's enough. 70% of our attendees have voted, which is fantastic. If we look at results, 38% of you currently have investment in shares in that category. Therefore, definitely consider the new categories in AASB 9. And, you know, start to think on whether you want to make that irrevocable election for certain of those investment in shares to go to fair value through other comprehensive income, or whether you want to put it in fair value through profit and loss. So those would be your 2 options going forward. Definitely think about that. 49% says no, and then a few unsure. All right, thank you very much for participating in that. All right, so if we look at, so once we've got the categories, and we've said we've got 4 different categories, what does it mean around recognition and measurement? So on the slide, I've got the 4 different categories, and I'm going to start with the bottom one. It's not a logical place to start, but there we go. Fair value through profit and loss, the bottom right-hand one. So what are common types of financial instruments that are sitting in that fair value through profit and loss? So, you know, investments in listed shares, if they're held for trading, interest rate swaps, any derivative, commodity contracts, futures, options, investments in convertible notes, you know, an amount receivable that's based on profits or a market index, contingent consideration receivables, investments in shares in unlisted companies. These are all examples of things that could sit in fair value through profit and loss. So I'm going back to my original example, which I've used earlier when I wanted to explain the impact on available for sale financial assets. So I'm using the same basic information and saying, so if in that situation, using the same investment in shares, if we are now accounting for this investment in shares in the books of entity K at fair value through profit and loss, what would the journals be? So when we buy it, we'll say debit the asset, credit cash $100. On the 31st of December, and I can see I've made the same thing. Look here, these numbers are the wrong way around. The debit and the credit there is right, but the numbers are the wrong way around. On the 31st of December 2018, the fair value of the shares is now $60, so I have to credit the asset with $40 because the fair value of the shares have to be reflected in the statement of financial position. So credit the asset $40, debit profit and loss $40, because here every change in the fair value of the asset just goes through profit and loss. Then in the next year, when the fair value goes up to 110, we're going to say debit the asset, the movement of 50, credit profit and loss 50. The good thing here, if you look at the previous slide, the loss went through profit and loss, and here the profit goes through profit and loss. And when we sell the shares on the 3rd of January, we credit the asset with the 110, we debit cash, end of story, no additional journal. So that is fair value through profit and loss, very easy, very simple. The problem with fair value through profit and loss is the volatility on your profit and loss, in profit and loss and on profit before tax. So what if instead of fair value through profit and loss, we land into this category, fair value through other comprehensive income, and specifically equity instruments? And remember, if it's a fair value through other comprehensive income, if it's an equity instrument, we know we cannot recycle to profit and loss. That's very important to remember. So key requirements of this category: it applies to equity investments that are not held for trading. Once it's not held for trading, you can make this once-off irrevocable election at initial recognition. All changes in fair value go through OCI, so you never have this current problem of impairment losses going through profit and loss and increases going through OCI. All fair value changes go through OCI. Very important bullet point 4, there's no recycling. So on sale, your fair value changes will not go through profit and loss, but it will be a direct, or you can, if you want to, make a direct transfer to retained earnings, which is what I would recommend. Otherwise, you're sitting with a revaluation reserve, but you no longer have the underlying asset in your statement of financial position, so it looks a bit odd. You would still recognize your dividends that you receive in profit or loss. And then, common equity instruments that are in this category would be investment in shares in listed and unlisted companies where you've made that election. Remember, it cannot be held for trading. So if I go back to my same example, and now we're saying what would the journals be for entity K if the investment in shares are accounted for at fair value through other comprehensive income. So exactly the same information. How would it change? So day one, debit the asset, credit cash 100. The end of 2018, we credit the asset with 40 because the asset is now only worth $60. Fair value is 60, so we credit the asset 40, debit a revaluation reserve, OCI, with 40. So it doesn't go to profit and loss. In the next year, the market recovers, so that now we debit the asset with 50 and we credit revaluation reserve, OCI, with 50. And remember that revaluation reserve at the end of 2019 is now sitting with a credit balance of 10. Then on the 3rd of January 2020, when we sell the shares, we credit the asset 110, we debit cash 110, and we're sitting with a revaluation reserve in OCI, but we no longer have the underlying asset, the shares. Therefore, we say get rid of that revaluation reserve in OCI, debit revaluation reserve OCI, and credit retained earnings. So this journal cannot go through profit and loss because you've made that irrevocable election to keep everything, all fair value changes, in OCI. So this is just a few examples using the same information where we contrast the current available for sale and the issues with fair value through profit and loss, where you've got volatility in profit and loss, with this alternative where all changes in fair value sit in OCI and neither go through profit and loss. The only thing going through profit and loss, if you use this alternative, is your dividend income. The third category that we'll be looking at is amortized costs. So we are assuming that we've passed both hurdles, the SPPI test and the hold to collect test, and we're accounting for a trade receivable or loan receivable at amortized cost. Common examples: trade receivables, loan receivables, intercompany loans and receivables, investments in term deposits. So all situations where we should use amortized cost. So here I've used an example where on the 1st of January, year one, entity A provided a loan to entity B, and the amount of the loan is $1,000. And let's say there's a transaction cost of $200 being paid by entity B. Now, I know my transaction cost is really big compared to the amount of the loan, but it's just to make to get a significant impact on the journals. Otherwise, it doesn't have a big enough impact to be able to discuss properly. So it's an unrealistic number, I know. Entity B pays interest of 10% per annum on that $1,000 loan in arrears, and entity B repays the total loan outstanding in 2 years' time, 31 December year 2. So in this situation, entity A has a loan receivable. And what are the required journal entries to account for that loan receivable at amortized cost in the records of entity A? So if you look at your solution, it's a bit of a process. The first step would be to calculate the effective interest rate in Excel or using a financial calculator. So in Excel, you use the IRR function. And if you put those numbers in Excel, which I've tested last night, the effective interest rate is 13%. And then you use that effective interest rate of 13% to prepare the amortization table, which I'll do in the next slide. So using Excel or a financial calculator, you can prepare an amortization table. So we start, your opening balance or your cash flow at the beginning is your 800. You've got your effective interest rate, which is 104 using the 13% interest. Remember, your cash flow is the 10% based on the loan amount of 1,000. So your cash flow is the 10. You've got your and you get your new closing balance, 31 December 20 x2, you have another cash flow, which is your 10% on the 1,000, and important to note that your interest, using your effective interest rate, your 13%, you put into your journal. So if you do your journals here, we'll say on the 1st of January, we debit your loan receivable, which is 1,000, credit cash 1,000, but they also pay a transaction cost, so we debit cash 200, credit loan receivable 200. At the end of year 1, we would say debit our loan receivable 104, credit our interest income 104, and we would say debit cash, credit loan receivable. And at the end of year 2, debit our loan receivable 116, credit interest income 116, and we've got our cash flow. And that has to go back to 0, so amortized cost. If we look at fair value through other comprehensive income, if it's a debt instrument and here we can recycle, how does it work? In your statement of financial position, you have it at fair value. If you look at profit or loss, you recognize interest revenue using the effective interest rate method. Your impairment losses and the reversal of impairment losses can go in profit or loss, and you'll apply the same impairment model as for financial assets measured at amortized cost. Your other comprehensive income is where you would recognize your cumulative fair value changes and recycle to profit or loss on derecognition. The other big change that we've got around the measurement of financial assets is around unquoted equity investments. So currently or going forward, all investments in equity instruments must be measured at fair value, and the cost exemption which a lot of entities currently use for unquoted equities are actually eliminated. And there's guidance being issued by the IFRS Foundation on how to come up with fair value for unquoted equities. So very important, if you currently use that cost exemption for investment in shares, in unquoted shares, you'll have to fair value those going forward. I thought again it would be interesting to see what you currently do. So if we look at another poll question, let me just see which one I want. Oh dear, I've got the wrong one. Don't know what I'm doing. Let's hide that one. Let's come up. So, do you currently measure an investment in unlisted shares at cost? So I thought let's just get an indication. How many of you currently use that cost exemption? Interesting. Quite a number of people currently use it. Very interesting. I'll leave it open. Voting is only around 45%. It would be interesting for more people to tell me what they think. Yeah, interesting, very interesting. I'll leave it a little bit more. We're around 60%. Do you currently account for your investment in shares at cost? Right, I think that's enough. 70% have voted. I'll share the result. At this stage, 40% are saying yes, we're using that cost exemption. 40% are saying no, and 20% are unsure. Very interesting. So if you currently use that cost exemption, the new AASB 9 would require you to fair value it, and there would be no cost exemption. So that's an interesting change for you as well. If we move on to the categories of financial liabilities, now in AASB 9 we've got two categories of financial liabilities. We've got amortized cost and fair value through profit and loss. The categories of financial liabilities are the same as we currently have in AASB 139. So if you want to look at amortized cost examples, we're thinking trade payables, loan payables, bank borrowings, and amortized cost means amortization table, etc. If you look at fair value through profit and loss, examples, that would be, derivatives, interest rate swaps, commodity contracts, foreign exchange contracts. If we look at the recognition and measurement of financial liabilities, this is where we've got a slight change. And the slight change here is that if you've got, just a second, the change we've got here is that changes in your own credit, accounting for the changes in own credit risk for financial liabilities designated at fair value through profit and loss under the fair value option. So what do I mean by that? If you look at, if there's a total fair value change on a financial liability of $10, the part of that change in fair value that's due to a change in your own credit risk is $8, then that $8 could go through other comprehensive income, and only the difference, the $2, would go through profit and loss. So if there's a change in your own credit risk, that can go through other comprehensive income. So this is only applicable if you're accounting for this financial liability at fair value through profit and loss. So that is a change in the new AASB 9. So if we recap some of the key changes today on financial assets, so we've got 4 categories of financial assets. So amortized cost, fair value through OCI for debt instruments, and therefore recycling is allowed. We've got fair value through other comprehensive income for equity instruments, and there's no recycling allowed. And we've got fair value through profit and loss. Now, the International Accounting Standards Board, the Australian Accounting Standards Board, they all like fair value through profit and loss, and therefore it's always available. You have to jump a number of hurdles to get to amortized cost or to get to a fair value through other comprehensive income. And there's no exemption going forward to measure investments in equity instruments at cost. And then also the default category for financial assets going forward is fair value through profit and loss, and not available for sale as we currently have. So those are the key messages that I wanted to cover today. 47 minutes, not bad. Newsletters, videos, webinars. If you're interested in newsletters, videos, or webinars, please register there, or link with BDO on our LinkedIn page, or with me on my LinkedIn page. Any questions, if you put it in the question bar, I would deal with that. Also, after this presentation, I'll distribute my slides which have the solutions on it. I know those journal entries, I've got the debits and the credits, the actual amounts the wrong way around. I'll quickly fix that before I send it out to you within the next few hours. But thank you very much for sharing this time with us, for joining us for this webinar. Any questions, please put it in the question box. And then I'll speak to you next week and next month. And next month we're talking about the new AASB 9, but impairment of financial assets, which is very different. So thank you very much for joining us.